Something just happened in the stock market that we have not seen in 50 years. And the last time this exact combination of events occurred, most people panicked, made the wrong moves, and lost significant wealth. A small group of people did the opposite. They understood what was happening, positioned themselves correctly, and got quietly and generationally wealthy. That was 50 years ago. Right now in 2026, every single piece of that puzzle has snapped back into place. Almost to the letter. This is not a video about fear. This is not a video about gold or crypto or doomsday scenarios. This is a video about data. What happened in the 1970s? What is happening right now? And what the investors who actually built real wealth during the last version of this setup did differently. Here is the economic combination that almost never happens. Economists call it stagflation. It means three things are occurring simultaneously. Prices rising fast, the economy slowing down, and the job market deteriorating. The reason stagflation is so dangerous is that the tools normally used to fix any one of those problems make the others worse. Cut interest rates to stimulate the economy, and inflation accelerates. Raise rates to fight inflation, and the economy contracts further, and unemployment climbs. You are stuck. The last time the United States was properly stuck in this situation was the 1970s, over 50 years ago. And right now in April 2026, every ingredient that created that crisis is back on the table. The money printing, the oil shock, the slowing economy, the Fed in an impossible position. Piece by piece, the 1970s setup has reassembled itself, and most investors have no idea what that actually means for their portfolio. By the end of this video, you will understand exactly what happened 50 years ago, why 2026 looks almost identical, and what the investors who built real wealth during the last version of this setup actually did. So make sure to stay until the end, leave a like, and let's start. To understand what is happening now, you need to understand what actually happened then. It starts in 1971. President Nixon took the US dollar off the gold standard, ending the requirement that every dollar in existence be backed by physical gold. The Federal Reserve could now print money without a hard limit. Government spending surged. The money supply expanded rapidly. Too many dollars chasing the same amount of goods. That is inflation. Then in October 1973, Arab members of OPEC launched an oil embargo against the United States in response to American support of Israel in the Yom Kippur War. Oil prices quadrupled almost overnight. And because oil is embedded in the cost of everything, food, transportation, manufacturing, every product in the economy, that oil shock sent inflation through the roof. The consumer price index ran at an average of over 7% annually for nearly a decade. In some years it hit above 13%. The Federal Reserve eventually responded by raising interest rates to over 20% by 1981. Mortgage rates hit nearly 18%. Businesses slowed. Unemployment climbed to 11%. Multiple recessions followed. That is the full picture. Money printing, then oil shock, then stagflation, then aggressive rate hikes, then recession. Now here is what is happening in 2026, step by step. Step 1. Money printing. After COVID hit in 2020, the Federal Reserve's balance sheet went from approximately $4 trillion to over $9 trillion in roughly 2 years. Trillions in stimulus. Government spending at historic levels. The money supply grew faster than it had in decades. By mid-2022, inflation hit 9.1%, the highest in over 40 years. Step 2. The oil shock. In early 2026, military action involving the United States and Israel led Iran to block the Strait of Hormuz, the narrow waterway that before the conflict handled roughly 1/5 of the entire world's daily oil supply. Oil prices spiked past $100 a barrel. At one point, the spot price hit $141, the highest level since 2008. Step 3. The economic slowdown. The Bureau of Labor Statistics reported that in February 2026, the US economy shed 92,000 jobs in a single month, and unemployment climbed to 4.4%. Core inflation sat at 3%, a full percentage point above the Fed's 2% target. Market veteran Ed Yardeni publicly raised his odds of a 1970s-style stagflation scenario to 35%. 1 in 3. Step 4. The Fed is stuck. Before the oil shock, markets expected rate cuts in June 2026. Now, cutting rates when oil-driven inflation is rising risks making inflation explode higher. But raising rates risks pushing a weakening economy into full recession. The CME Group's chief economist described it directly: huge budget deficits, inflation above target, central banks trying to ease policy anyway, and then $100 per barrel oil, the same impossible position as 50 years ago. Now here is where the story becomes genuinely instructive. 3 investors each had $100 per month to invest, starting in 1971. Same amount. Completely different results over the following 2 decades. The first investor put $100 per month into the S&P 500. Over 10 years from 1971 to 1981, that $13,200 in total contributions grew to approximately $21,500. A 60% gain, but inflation over that decade ran at roughly 124%. In real terms, the purchasing power of that money went backwards. The second investor kept $100 per month in a savings account. In the 1970s, because interest rates rose so aggressively, savings accounts were actually paying 8%, 10%, even 12% annually. That $13,200 grew to approximately $20,000 over 10 years. Still behind inflation, still losing real purchasing power, even at historically high savings account rates. The third investor put $100 per month into gold. From 1971 to 1981, that $13,200 grew to approximately $45,500, a 245% return. Gold crushed both the stock market and the savings account over that decade. But here is where the story gets complicated. And this is the part almost nobody hears. Extend the window to 20 years, from 1971 to 1991. The S&P 500 investor who kept contributing through all the crashes and recessions grew their total to over $133,000, a return of over 430%. The stock market finally and decisively beat the cumulative inflation rate of approximately 236% over those 2 decades. The savings account investor grew to approximately $60,000. Decent, but still falling short of inflation in real purchasing power terms. And the gold investor, the big winner of Decade 1, grew to approximately $52,000 over 20 years. Last place. Nearly the same result as a savings account. Because when Fed Chair Paul Volcker crushed inflation in the early 1980s, by raising rates above 20%, inflation fell, the dollar recovered, and gold crashed. Gold is a fear asset. It rises when people are scared. When the fear passes, it falls. The investors who bought gold in 1971 and sold at the peak in 1980 made extraordinary money. The investors who held it thinking it would keep going won nothing and eventually lost their advantage. So what does 2026 actually look like for the investor who understands this history? Here is where it differs critically from the 1970s, and getting this wrong is expensive. The 1970s did not have artificial intelligence. They did not have a massive restructuring of global supply chains. They did not have a semiconductor shortage, a helium crisis threatening chip production, or the near-complete reshaping of global energy infrastructure. The threats are similar. The opportunities are in completely different places. And if you are using a 1973 playbook to position for 2026, you are going to miss the actual opportunities entirely. According to the Citywire Q2 2026 market commentary, institutional attention has shifted decisively toward 4 areas. Energy. When oil hits $100, $120, $140 per barrel, the companies that produce, refine, and transport that oil benefit enormously. In 2022, the last major oil spike, the S&P Energy Select Sector Index returned approximately 65%, while the broader S&P 500 lost 18%. Similar conditions are now present in 2026, and the United States is now the world's largest oil producer, meaning US energy companies benefit even more than they did in the 1970s. Defense and aerospace, with an active conflict in the Middle East and defense budgets expanding across NATO, Europe and Asia, defense company revenues are rising. Multiple NATO countries have dramatically increased spending following the reshuffling of global security assumptions. The physical backbone of AI, Goldman Sachs and VanEck have both flagged that AI capital spending is now moving from digital software and chips into the physical infrastructure required to run it all. Data centers need enormous electricity. They need cooling systems, semiconductors, copper, rare earth metals, transformers, and power lines. VanEck specifically noted that natural resource equities and real asset exposures are already outperforming the broader tech sector year to date in 2026, and real assets more broadly. Charles Henry Monchot, Chief Investment Officer at SYZ Group, wrote in March 2026 that this environment could represent a sustained shift from paper assets to hard assets and physical things. Energy, copper, steel, critical minerals. For 15 years, the biggest returns came from owning software companies with no physical assets at all. That playbook may be changing. Here is what the 1970s actually teach us. The investors who lost were the ones who did nothing, who kept cash, watched inflation destroy its purchasing power, and called themselves safe. Safety that does not beat inflation is not safety, it is slow wealth destruction. The investors who won over the long run were the ones who understood two things: what economic environment they were actually in, and where money was being forced to move because of that environment. In 2026, money is already moving into energy, defense, physical AI infrastructure, and real assets. The pattern is not identical to the 1970s. But the logic is the same. Find where economic pressure is creating genuine demand. Position yourself there before the headlines fully catch up. Because by the time you are certain, the prices of the winning assets have already moved. The first thing you can do right now, tonight, is look at your current portfolio and ask one question. Do you have any meaningful exposure to energy, real assets, or the physical infrastructure of AI and data centers? If the answer is no, that is not a reason to panic. It is a reason to research. One small allocation decision made with understanding is worth more than a large one made with fear. Subscribe to this channel so you do not miss what is coming next. And watch the next video on screen. We already broke down the exact compounding strategy to use right now during a market downturn, and that strategy connects directly to everything you just learned here.